Welcome to today's presentation where I have the pleasure to present OrderYOYO. To help us do today's presentation, we are joined strongly from the company CEO Jesper Johansen, CFO Jesper Hyveled, and Deputy CEO Mathias Thom, joining us from Germany. Today's event will cover your Q4 update released last week. Again, results surpassing guidance, a guidance that was upgraded 5 times. And you also raised 24 guidance, showing that this momentum might continue. And we got some hints and aspirations on your long-term margin. So a lot of ground to cover, so I will soon show up. As always, it will be possible to ask questions in the box down below. Do it during the event. We will probably take most of it in the end. But that was for me. I will hand the word over to you now, Jesper.
Thank you, Michael, and welcome everybody to our Q4 presentation. Our CFO Jesper Hyveled, Deputy CEO Mathias Thom, and myself are really looking forward to this presentation. Next slide, please, Michael. So let's just dwell 15 seconds on this important information. Yes, and let's move on. Next slide, Michael. So a quick overview. Important to start with our aspirations, our vision, our mission, our purpose. What are we doing? So we liberate your local independent takeaway restaurant, making sure that the local restaurant is empowered to take fully control of its own customers, with 2 benefits. Number 1, owning their own customers, and obviously with a large cost saving compared to portals. This has been our purpose from day one and is still our purpose, and something that we fight for every day and night. So 3 quick insights here. Still number 1 in Europe, and is actually improving that position so strongly, and undisputed market leader in Europe, especially in the 2 largest takeaway markets in Europe, Germany and UK. ARR growing of 40%, so reaching 296 million, just short of 300 million this year. Significant above our latest guidance, that was 270 to 275, even though we actually have raised that guidance 5 times, as Michael just alluded to. So super strong and good numbers that is by far outpacing the market. And on top of that, and we will get back to that a little later, we have very strong EBITDA performance. Our target was 22 to 24 million. We reached almost 26 million in EBITDA, a 10% EBITDA margin. So very strong results and a very strong Q4 taking us into 24. Next slide, Michael. And next slide. So this is a slide that you guys have seen before, and it's basically that size and profit matters, because that's the platform for market share gains. That's what drives our earnings. So as just described, 296 million, 40% growth in ARR, driven in 5 countries where we are market leaders in all 5 countries: Germany, UK, Denmark, Northern Ireland, and Austria and Ireland. And a full year EBITDA of 25.6 million. The fact that we are number 1 is actually some of the stuff that drives our growth and drive our profitability significantly. Over to you, Mathias.
Thank you, Jesper. So next slide, please. Let's talk about the current external market conditions, which didn't change much from our last presentation. For restaurant partners and end users in the UK, the market conditions remain tough, which is driven by inflation and various number of other macroeconomic factors. For Ireland, the situation for restaurant partners is moderate and remains tough for the end users. Denmark, Germany, and Austria will still face for restaurant partners and end users a steady, moderate situation. We have proven a resilient and strong performance on all markets, with a growth of 32% in GMV compared Q4 2023 to Q4 2022. We continue gaining market shares from both portals and other white label providers and expect to continue to do so in 2024. Now I will hand over to Jesper Hyveled, our CFO. Next slide, please.
Thank you, Mathias. Now we'll give you the highlights of our Q4 and full year 2023 performance. So next slide, please, Michael. So as already alluded to, our ARR grew by 40% from 212 million to 296 million in December 2023, so just below 300 million, a milestone and the highest ever reported ARR for OrderYOYO. Next slide. Full year net revenue, a growth of 38%, growing from 184 pro forma 2022 consolidated net revenue to 253 million consolidated net revenue. Again, a growth close to 40% and all-time high. Next slide, please. December 2023 GMV growing by 32% to almost 3 billion DKK, coming from 2.2 billion in 2022. Again, strong number in a challenged market with the market conditions that Matthias just alluded to. Next slide, please. So our reported full year EBITDA growing from just below zero, around -1 million in 2022, growing by 26.5 million to 25.6 million in 2023. Again, very strong. And I will let Jesper speak a little bit more about profitability. So over to you, Jesper.
Thank you, Jesper. Next slide, please. So what we have seen over the last quarters is a significant increase in our EBITDA performance. Back in Q1 22, we initiated two strategies which basically were interconnected. So we introduced a active M&A strategy that should help us increase our market leadership position, and we implemented what we call our path to profitability strategy, where we wanted to have a strong focus on profitability. Up until then, this company had been very much about growth, so we have quadrupled the revenue and the ARR in the months, the years from 18 to 21, and a more balanced view towards growth and a balanced view on profitability was implemented. Now, what we have seen over the last quarters and has been very clear in the Q4 quarter is actually that the strategy that we implemented is showing results earlier than originally anticipated, and it's driven basically by three things. We have remained a high growth, so we are experiencing growth between 30 and 40% in all quarters. This compares to a market that is basically flat, so we are outgrowing the market by a big margin. We have a strong operational leverage, so the ability to get more out of the same costs has shown to be able to be implemented quicker than anticipated. And then obviously M&A activities we've made both in terms of the AppSmart transaction back in 22 and the King Food and Gusto acquisitions in 23. We have seen significant cost savings on those as well. So the EBITDA and profitability path has definitely become implemented at a much higher pace than anticipated originally. Next slide, Mike. This also means that we have significantly raised our EBITDA guidance. So back in 21, we had around a zero EBITDA. We had that in 22 as well. In 23, we are doing plus 25 million. We're originally guiding for a EBITDA of between 23 and 28 million for 24. Now, because of the results that we are seeing from the path to profitability strategy, we have increased that guidance significantly. So from 23 to 28 million to 33 to 38 million, a 40% increase in guidance. So we are seeing a significantly better EBITDA performance than originally anticipated in terms of the long-term path to profitability strategy. Next slide, Mike. Now, this also shows in our margins. So obviously in 21 and 22, we were just around zero. In 23, we had a margin of 10%. Our original 24 guidance was between 9 and 11, and that has now been raised to 11 to 13%. And for the first time, we are releasing our long-term EBITDA margin goal of more than 25%. We do think that we long term is a company that will be able to generate a 25% margin in an industry like ours with the operational leverage that we have. So our long-term goal for the EBITDA margin is 25% or above. This is the first time we're saying that. Over to you, Jesper, to take us.
Thank you, Jesper. Next slide, please, Mike. So part of our path to profitability is obviously also our cash EBITDA. And for the first time in 2023, we started reporting on cash EBITDA. Now, since mid-year 2023, we have been cash EBITDA positive. And here it's important for everyone to understand and notice that our definition of cash EBITDA is our EBITDA subtracted with the capitalized development costs. Basically, this shows the operating cash flow as we define it as, and that is being reported as cash EBITDA. So, as Jesper just alluded to, the better performance on our profitability, the earlier performance on the path, actually shows that we are now able to have a full year cash EBITDA surplus just above zero. Something that is also beating the initial plans, and we are super proud that we can now actually be cash positive, cash EBITDA positive for the first time for a full year. That leads me into the 2024 guidance. So next slide, Michael, please, and one more, please. So the original guidance on ARR, we increased now with the Q4 announcement to 315 to 325 ARR. The net revenue also increased to 275 to 285 million, an increase from 260 to 270 million. GMV also increased from 2.8 to 3 billion DKK to 3.1 to 3.3 billion. Now, EBITDA, as Jesper just alluded to, was significantly raised to 33 to 38 million. And finally, our cash EBITDA, we now guide upon, and the guidance here is between 5 and 10 million positive cash EBITDA for 2024. That was the final comment from me. Now over to the Q&A session with you, Mike.
Perfect. Well, let's start with the first question. Are you considering moving to be listed on the main exchange?
No.
That was a very clear answer. So I will stick it. Do you want to comment around it, or is
well, I think we've talked about this before. So I think that the position that we have now on First North in terms of liquidity is as it is. I haven't seen any particularly strong arguments in terms of liquidity in any of the First North companies that have moved from First North to the main listing. Now obviously it is, and that's why, you know, of course there is more to it.
I know.
But that is why it is a no, because we're not focusing on that right now. We're focusing on delivering on our results, and then eventually we will consider that if we're big enough. I think that we are significantly bigger than the companies that have moved, so that's a positive thing. But I don't think that just moving from one exchange to another change a lot of problems. It's magic that doesn't work, to be honest, in my book.
Yeah.
So we'd rather focus on delivering on our numbers than going through a process where we do this.
Copy. That was also your answer last time, so you haven't changed that. Thank you. Your guidance implies around 6 to 10% ARR growth in 2024. Why do you expect growth to slow that much compared to the 40% ARR growth in 2023? And secondly, question, does that mean you should view OrderYOYO, view that as a company that's a high single digit or low double digit ARR growth in the years after 2024? Or should we expect higher growth rates about that? So the first question, why does it slow so much down? And secondly, maybe a little bit about your thinking on the long-term growth targets, not targets, but what you could see your company growing.
Yeah, I think so. For the first one, we had an extraordinarily strong 23. So growing 40% is very, very high. And we've raised guidance several times, 5 times, and was beating that. So we have a history of being conservative, and we are that on our 24 guidance as well. We want to make sure that we can deliver. Now you have to remember that right now, if you look at the end user situation, so if you look at the portal indications, everybody is around 0, so there's no growth in this market. So growing 40% actually means that we're taking a lot of market share. So with 6 to 10% on the low side, and doesn't look conservative, I can see that, but we want to make sure that we can deliver. Longer term, we haven't alluded to or given any aspirations or longer term growth rates, and I don't want to do that here. But what I can say is that we will continue taking market share because we have a product market fit that is extremely strong. And we do expect that we, over the next years as well, will keep on growing and outgrowing the market.
So to allude a little bit about the competitive situation, you are not seeing they're changing their behavior, going more aggressively for growth or anything. That's not what is behind your guidance assumptions.
No.
Is that correct?
No, that's correct. It's not. The competitive situation has not changed. Yeah, that's not why.
Perfect.
It's our internal things.
And then there's a question here regarding your investment or investments you need to grow. How much staff will you need to hire to satisfy your growth ambition, and what division departments will you hire mostly going forward? Sales, product development.
Let me take that. So our main investment for 2024 will be in our commercial organization, meaning sales. So most of our hirings will be within sales in all markets, and that's basically to drive more activations. We will also invest in our product. But we do feel that the current level of investment fulfill our current roadmap. So not significantly additional investments in our product compared to our current run rate. So the investment in 2024 should be seen as commercial investments in growing, basically.
And I guess you are implying again a strong operational gearing this year. Can you talk a little bit about maybe in the nitty gritty what is it that has given you this operational gearing this year and also giving it next year? Is it the success rate of your sales department pushing that up? Is it more outbound calls? Is it more inbound calls that is easier to handle? Maybe you can talk a little bit about the operational gearing so we can get a little bit feel on how it was so successful in 23 and your expectations for 24.
Yes, let me start, and then Jesper, you can take over. Operational leverage of gearing is actually happening in all departments. So this is not only a commercial thing. So basically, it means that we've built an engine. Build the product, build a sales engine as well, commercial organization, a financial organization that is capable of doing more without having to add extra costs every time we're doing more. And that's actually what's happening in all departments, both development, commercial, financials, all over the place. Now, obviously, that has a lot to do with building the right processes. It's to do with building the right projects. It's to do with building and looking at the right customers. And it's to develop and focus on doing the right products. Now, all that ties back to what we did when we implemented our our path to profitability strategy in Q1 22, so 8 quarters back. And this is just the results of that. And this will continue as we grow. Obviously, we do have to increase cost as we grow, but not to the same extent as what the revenue will do. Yes, anything to add?
Yeah, fully echo that. And then you can say, yes, the journey started first back when we acquired AppSmart in 2022. But you also have to remember that the smaller acquisitions that we've added in 2023 takes a while until we have fully implemented and gain all the synergies. But the synergies will continue to happen, and we as an organization just always strive to work smarter, and that we will benefit on the profitability track on that in all aspects.
And perfect. Maybe to touch upon it, I jump a little bit in the question. I will cover everything. So, but can you comment a little bit on the organic growth you had in Q4 and in 23? So, how much of the growth, the revenue growth, was organic in 23?
Majority, the biggest majority was organic in 23.
Yeah. So the smaller purchases, they didn't show much on the revenue side. That was mainly a small increase to your ARR. Is that correct?
Yeah. I mean, if you look at Gustoco, I think that we actually told how much it was. It was around 4 million on ARR. So four out of a growth of around 80 million. So that's less than 5% that's coming from acquisitions, and then a little bit from Kingfood as well. So the large majority here is actually coming from organic growth, which is where we are taking market share. Correct?
Can you talk a little bit about the growth drivers? Has it been price increases, cross sells, and such stuff? Talk a little bit about that, or is it new customers, older customers, where you are able to increase the GMV on?
Did you go? Yeah.
No, so basically a large part of this is actually market growth or taking market shares, and you will see that just by the fact that we're growing our GMV by 32%. Now, with that said, everyone can also see that the ARR increases is higher than the GMV increases, and that's obviously because we've been able to do upselling. So the part of the post-merger migration plan was to, and we talked about this several times, was to sell the same product, sell our growth product in South, and that's both driving GMV up, but it's also driving our revenue up or our ARR up. So it's a part of both, and then having a more one-fits-all product delivery methodology, but also more similar pricing, both with the market and with our cross-country benchmarks.
And you just showed upon it, and a question coming. Explain the difference in ARR growth and GMV growth in 23. Is that driven by a mix of revenue streams or price raises? You touched a little bit upon it, but can you kind of decompose that growth difference?
Yeah, it is a mix. So part of this is driven by adjusting the prices. It's not that we've seen high price increases, but we have adjusted so they're more like for like, and we also did market benchmark to, and then it comes with new product offering as well. So we have also introduced a new product offering during 2023 and also in Q4 versus Q4 22. So it is a mix. It's also a mix of where the GMV growth is, because the ARR per GMV is different from market to market, and that's also what's driving this. So that's not one clear answer here. It's a bit of a little bit of everything, I would say.
Then there's a question: will the long-term ambitions of 25% immediate market require further M&A activities, or saying, if there was not those possibilities, could you do it on the current business you have?
We could do it on the current business. That would probably take a little longer. So the M&A activities can be seen as catalysts in terms of time on when to reach 25%. But the 25% EBITDA margin would also be our goal in a purely organic setting from now on. But it will take a little longer. And then of course the next question is, what's long term?
Yeah, the timeline.
That's,
you open up for that.
And that's obviously so. This is also to do with sometimes people call it steady state. So it's more than 5 years out, right? Under normal circumstances. But I can't say whether it's 5 or 5.5 or 6 or 7 or 4. I mean, but it's that kind of framework we have to look into, right? And then obviously we have to kind of look at the path towards that, and that's why we've kind of have been bold enough to put out the number there, because we can see that we are working towards it. And then basically the proof will here be that in the process and in the next quarters and years, we will increase our EBITDA margin towards 25. And Jesper has something to say.
Yeah, just echo completely. And then I think it's important to understand that this you can say this is the newest or the latest path that we've introduced. And we've shown that we can deliver on our various paths. This is a little bit longer, but we feel rather comfortable, and we also have plans that suggest in the, after midterm, so long term, that we can reach this. But as Jesper said, M&A activities will definitely drive the pace up.
So that makes sense that it's hard to give a timeline because it's hard to time or fully know how you do M&A. But it is a long-term ambition, and what we as investors should see is that you increase that every year. That's the way we should look at it.
Yeah, exactly. So the path has started, and we will continue to deliver on that.
Then there's a broader question. How do you view the current valuation also in terms of multiple and peers? So I know it's a little bit touchy field to ask a CEO to talk a little bit about valuation, but let's look at your own valuables and what you see in markets. Any comments on that?
I mean, it's obviously difficult for us to kind of comment on our market price. The market sets the price, and we just deliver the numbers. Now, obviously, if you just look at it, I think we have a market cap at the current level around 750 million. We're trading at 2.3 times ARR historically, so realized ARR multiple of 2.3, growing at 40% at a plus 10% EBITDA margin. Investors have to kind of look at that and compare it to what else is out there on the SaaS industries, and then either add or subtract from the average in terms of that we have a 60%, 65% commission-driven usage-based ARR and a 35% fixed price ARR. Sometimes that's in favor, sometimes it's not. So basically, the only thing I can do or we can do is to deliver the numbers: 40% growth, 10% EBITDA margin, 2.4 times ARR. People have to do the math whether they think that's cheap or not. What's important for us is when we go forward and we acquire companies, when we do it for shares, that we do it either at the multiple or below that we have done historically. Now, that doesn't mean that if we find the golden diamond somewhere that we would not be bold to pay a high multiple if it's the right company. Because if it's the right company, we will pay the price because we can see how we extract value and earnings from acquisition. So we probably are a little more bold on that path right now. But I think that the only thing I can say is to say the objective part of this, which is a 40% growth, 10% EBITDA margin, and 2.4 times ARR. People do the math.
Thank you, Jesper, for that broader comment. That was the last question. Thank you to you, Jesper and Matthias, for taking us through your results, and thank you for the audience listening in.
Wonderful. Thank you guys
very much.
Thank you, everybody.
Bye-bye.